Now, Reformation priced its initial public offering at the bottom of its marketed range at $15 a share, as the company with a market value of nearly $0.9 billion, not the billion dollar, towards the lower end of its early range rather than away from it. The market did not reject the offering, it simply declined to award the premium that the story was asking for. And that hesitation is the entire piece that we want to talk about with you. At roughly 1.7 times trailing revenue of about $533 million, Reformation still sits at an awkward middle. And well beneath the growth cohort names that it would rather be compared to, for example, Aritzia and On, both around 4 times sales. Hello everyone, welcome back to our channel and welcome back to this video. In this video, let's talk about Reformation's IPO and what it reveals about the luxury's negative space. And let's focus on financializing the medley. So essentially what we are talking about is that a rare fashion listing arrived price is a category question that the market cannot yet answer. And in trying to convert buzz into a public multiple, it exposed what luxury financialization actually required. So let's do a deep dive and let's try and understand that. Let's first start with the setup. Now, Reformation priced its initial public offering at the bottom of its marketed range at $15 a share and opened flat on the New York Stock Exchange on 30th of July. The listing raised roughly $211 million and left the company with a market value of nearly $0.9 billion, not the billion dollar, 2 times revenue figure that circulated during the roadshow, but a step below it. And in the days since, the stock has drifted towards the lower end of its early range rather than away from it. The market did not reject the offering, it simply declined to award the premium that the story was asking for. And that hesitation is the entire piece that we want to talk about with you. At roughly 1.7 times trailing revenue of about $533 million, Reformation still sits at an awkward middle, richer than the legacy mall retailer like Gap, which trades at nearly half the revenue, and well beneath the growth cohort names that it would rather be compared to, for example, Aritzia and On, both around 4 times sales. A revenue multiple is actually a compressed narrative. When the market cannot decide which comparison set a company belongs to, the multiple lands in the gap between them and waits for evidence. Reformation has been placed provisionally in exactly that gap. The interesting question is not whether the debut was hot or cold, it's what the company is being asked to prove. Reformation is a test of a specific proposition that has quietly organized the whole cohort of brands over the last decade, and that there is a durable, investable tier of apparel sitting just below the designer pricing that a brand can occupy profitably and at scale. The IPO poses that proposition into the open because a public multiple is a claim about permanence. This particular video and this note names the tier, explains where it came from, and then asks the harder questions that the listing raises. Whether the thing that makes a tier attractive can actually be manufactured or can it only be inherited? And when we are trying to answer that question, let's start with the structural category. The below designer tier is usually described as a price band, premium apparel that stops short of luxury, roughly at $100 to $900 a dress. Now that description is accurate but almost useless because it treats the entire tier as a coordinate on a price axis rather than a thing that is produced by a mechanism. The mechanism matters more than the coordinates. Over the past decade, luxury has financialized. Houses learned how to treat brand equity as balance sheet asset and to monetize it through price rather than the product, raising ticket prices well ahead of any corresponding advance in design, material, or craft on the theory that scarcity and heritage would absorb the increase. For a long stretch, it did. But the price taken faster than the value creates a vacuum beneath it. Aspirational buyers who had been priced into the entry-level luxury were again priced back out. And they did not stop wanting the thing that luxury used to sell them. Newness, a sense of taste, an object that can be photographed well. They simply needed somewhere else to buy it, and that vacated space is where the cohort lives. Reformation, Cezanne, Stodd, and at the more accessible and now much larger end, Aritzia. These brands did not invent a category so much so as occupy a room that luxury walked out of. And understood this way, the tier has a defining property that the price brand framing hides entirely. And that property is the negative space. Its existence is defined by the shape of what surrounds it. That is a structurally different thing from a heritage house. Its position is defined by what it is rather than by what its neighbors have failed to do. And it is the property that governs everything that an allocator should worry about. And this brings us to the reflexivity problem. Negative space is a contingent space. The tier is attractive precisely because luxury has been indisciplined, because it keeps taking the price without adding value and keeps alienating the aspirational buyer, which means that the cohort is in effect structurally short luxuries and discipline. The position pays out for as long as the houses keep misbehaving, and it compresses the moment they stop. There are two ways that the room refills. The first is that luxury reprices downwards or slows its increases, reopening the entry-level access and pulling the aspirational buyer back up the ladder. The second, much more dangerous for the cohort, is that luxury actually re-innovates, rediscovers product as the driver of desire rather than price, and reclaims the newness that the tier has been supplying in its absence. Either move narrows the opening, neither is under cohort's control. A brand whose addressable space is defined by the competitor's ongoing error is holding a position that it did not build and cannot defend by its own effort. And that is what makes this tier genuinely different from the luxury as an investment object, and why importing luxury's multiples into it is a category error. A heritage house compounds its own moat, and that moat is endogenous. A below designer brand rents its opening from the house above. The rent is cheap right now because luxury is distracted and overpriced. It's a mistake to capitalize cheap rent as if it were an owned freehold. The correct discipline is to ask what the brand has built that would survive the room refilling. And that question is what the moat scorecard in the next section is designed to answer. Let's talk about financializing without the moats. Now, here's the reframing that the IPO makes possible. Luxury financialization worked because the houses placed durable moat primitives that made brand equity bankable, real pricing power, control of production and scarcity, quality that functions as truth rather than as a claim, and heritage that could not be replicated at speed. And when we are talking about an IPO itself is an act of financialization, an attempt to convert brand into a capitalized multiple. So the honest test of Reformation is not whether it's a good brand, it is whether it holds the primitives that made financialization durable for the houses that it implicitly is comparing itself to. So here on your screens is the exhibit of the moat scorecard, the Reformation versus luxury's financialization primitives. So when we're talking about the primitives, we have pricing power, supply chain control, quality as truth, heritage and scarcity, and repeat customer economies. And now let's compare all these primitives to the evidence and the verdict. When we're talking about the pricing power, it falls in the range of 98 to 898 and sells 80% of its direct product at full price, but the authority is trend-driven and not brand-driven. It holds when the dress is current, not because the name compels a premium. So the verdict out here is partial. When we are talking about the supply chain control, the pitch is more of a test and scale and detects clone, and the numbers contradicted. The inventory turns roughly every 102 days versus Aritzia, which turns at nearly 78 days, and Inditex, which turns in under 70 days. Speed that does not show up in the turn is a slogan and not a system. So herein we can say, in terms of verdict, it fails. Let's talk about quality. A brand that is premised on quality plus sustainability carries around 12% dead stock materials, often synthetic, and are visible based on customer complaints about the make relative to the price. The claim and the object really have separated out here. So here also we can say in terms of verdict, it fails. And when we are talking about the heritage and scarcity, cultural presence is real but rented from the feed, celebrity sightings and campaign buzz. Buzz is not heritage, it does not accrue, and it can fade faster than it is built. So herein we can say in terms of verdict, it is very weak. Let's talk about the last premise out here, repeat customer economics. About 70% direct-to-customer revenue comes from returning customers. This is the one primitive that Reformation genuinely owns, a behavioral mode that does not depend on luxury's posture at all. So herein, in terms of verdict, we say it is very strong. So overall, we can say that the Reformation resolves into single uncomfortable reading. On 4 of the 5 primitives that made luxury's financialization durable, Reformation is partial, weak, or failing. And on 2 that fail outright, it fails specifically against the claims that its own narrative advances. It is not simply the supply chain control and quality are absent, it is that they are load-bearing beams of the pitch. The one primitive that it truly holds, repeat purchase behavior. It is real and valuable, and notably, it is the one that does not depend on luxury's posture. But a single behavioral mode is a thinner thing to capitalize at a growth multiple than a stack of 4 reinforcing ones. The brand is trying to be financialized without holding what made financialization stick. And this brings us to the last section of the video, which is valuation as a referendum. Return to the multiple with that rating in hand, and at 1.7 times revenue, Reformation is priced as a genuine straddle. And the two poles of the straddle are not abstraction, they are named outcomes on a comp table. Here and on your screens, you can see where Reformation sits in terms of selected comparables with respect to Aritzia, Orange Holdings, and Gap. The vectors nearly all point one way. Growth is decelerating 16% in 2025 against 22% the year before. And the deceleration looks stronger now than the roadshow implied. Aritzia posted 43% in its most recent quarter and guides to the mid-20s when the Reformation was slowing. The next leg of Reformation's growth has to come from physical footprint, a plan to roughly double the store count over the next 5 years on the order of 13 to 14 openings a year, and the store growth is capital intensive in a way that pressures the double-digit operating margin that the private equity owner has carefully protected through a direct-to-consumer, low wholesale mix. Add the markdown risk latent in a 102-day inventory turn at a trend-chasing brand and the weight of the evidence pulled towards gap end of the straddle, a slower, thinner margin, mall cadence retailer that the market prices at near or below one-time sales. The counterweight is the one primitive that sports strong 70% repeat revenue is a real annuity. And if it holds, if the returning cohort keeps returning even as the buzz cools, it is the thread that will carry the brand towards the Aritzia end rather than towards the gap end. In conclusion, we can say that the referendum embedded in 1.7 times multiple is precisely this. Does the repeat customer moat outrun the decelerating growth, margin pressure, and the markdown vectors, or do they outrun it? The market for now has declined to prejudge. It has priced the question but not the answer, which, given the scorecard, is the intellectually honest place for it to sit. That's all that we wanted to share with you in terms of Reformation, its IPO, and luxury financialization. Stay tuned in for our next episode.